This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are starting a fresh new week here and coming in with all the enthusiasm after that big win on the cricket field, and hopefully, we continue that momentum and enthusiasm later into this week in markets as well. We're coming to you from the CNBC-TV18 Motilal Oswal studios, and I'm Prashant. With me, my colleague Sonia, and Rima is with us as well today. Guys, hi. Morning.
Hi, good morning.
Good morning, Rima.
The last week of the Samvat gone by.
And what a way to start it, right? I mean,
absolutely. The win, the pickup in the global market.
Absolutely. I mean, what a great match yesterday, of course, and absolutely fabulous performance from Virat Kohli. His 49th ODI and pretty much, giving himself a birthday gift. It was celebrations galore, absolutely. And I mean, this time just sort of bulldozing all the teams, right?
That's the only wrinkle, right? I mean, it's like so one-sided. It's like a drubbing, right?
Yeah.
I mean, so I was reading that the South Africans, and it's absolutely true, that they didn't even get to Kohli's score.
Yeah.
Right? So which is...
I think from a viewer perspective, it's not fun, but from the team, just if you look at it, the kind of performance that they're, the top-notch performance, just goes to show that they're sort of invincible, right? Yeah.
We'll ask Nimesh how was the viewer performance because he was there. We'll get a pitch report a little later on the program. All right, well, it's absolutely great. 8 games, 8 wins, and we're at the top of the league table. Let's just look at whether the market here can also turn around its fortunes a little bit, right? It does look like that perhaps we are set to reverse our fortunes as well. I'm talking about the global market. So let's start with what you need to know as we begin another day, another week. So U.S. equities continue to rally as bond yields continue to fall. It's as simple as that. Bond yields were rising. They had gone to 5%. Equities were sulking. Yields have sold off and equities are rallying. Now, the 10-year in the U.S., the U.S. 10-year is cooled off 50 basis points from the peak of about, 5.0 something. So that's a big sell-off coming in at about 5 or 6 trading sessions now. On Friday, we got the U.S. jobs data. The headline number was, adjusted for the auto strike, was largely in line, but there was enough detail which kind of showed you that it kind of gels with Fed Chair Powell's sort of speech after the Fed meeting last week that it perhaps looks like a soft landing. It looks like the economy is trending down nicely. Just for context, the unemployment rate in the U.S. Is down about 0.5% in the last 6 months. That is consistent with an economy which is slowly coming off, gently coming off, not in a very sharp way. What did Powell say? The message was very clear. The inclination was very clear that he would prefer to hold the line as far as further rate increases are concerned. And the market consensus has also moved. There were a few mainstream economists who were holding out and saying that, maybe the Fed will hike in December, etc. But bulk of all of those people have now kind of fallen in line. And the base case is now that the hiking cycle is over. Nearly 500 basis points done in this hiking cycle over the last year and a half, and now we are done. Now, on Friday, just to get back to the day-to-day action, NASDAQ was up about 1.4%. The Russell 2000, which is the small cap index in the U.S., was up almost 3%. So these are strong returns, daily returns that we're looking at. On Friday, the 10-year in the U.S. lost 9 basis points. We're at about 4.57. And, of course, cumulatively, as I said, from the highs, we're down about 50 basis points. Dollar index is sold off, a full 1%, by the way. It hit almost 105, so we're not talking about 107, 107.5. So it's come off sharply. And oil also at about $85, which is a good $7, $8 lower as compared to the high hit post the sort of Israel conflict broke out. So this is a pretty positive backdrop to begin the week, begin the trading session with. So it's thumbs up from global markets, and it's up to us for the market to perform. Now, the Nifty on Friday closed exactly at the 38% retracement of the October fall, almost exactly at the retracement. We left off at about 19,230. Next level on the upside is the 50% retracement, which comes in at 19,344. Now we're looking at the bigger retracement. We're looking at the fall from not just the October fall, which was 7 days worth, but the fall from the all-time high in September to the lows that we made last week, the week before. So that number is 19,344, the 50% retracement. And after that, I mean, we'll talk about the 61.8%, which is at about 19,463. By the way, that is also where the 20-day moving average comes in at. The 20-day moving average is at about 19,424. And the 61.8% retracement is at 19,463. So almost coinciding, both those levels. And that's the big one to take out. I would imagine that looking at the way things are, you perhaps will test that and perhaps even higher in the days to come. Supports for the Nifty, broadly, I mean, you've got to look at very near-term levels at about 19,100 or so. So that's the marker on the downside. Bank Nifty has been the weakest of the indices, the frontline indices. It should first test the 20-day, which stands at 43,600, which is nothing, which is about 300, 350 points away from where we are right now. After that, the 50% of the fall, the fall from the all-time high to the low comes in, which is 43,600. That is 44,200, which comes in. 43,600 is the 20-day. So these are levels on the Nifty Bank as well. Immediate supports come in at about 43,000 levels on the Nifty Bank. Again, just about 300 points away. And of course, I mean, the strongest of the indices has been the small cap index, not just here, but globally, right? The small cap index is now just 1% away from all-time high levels. That's it. It fell the most. It fell 7% in that, drawdown that we got, but it's come up the maximum, and it's almost at back at where it started from, which is, just about 1% off. The GIFT Nifty will come up on your screen. It's always desirable to get a little bit of a weakish kind of open, but I think it's hard. It's tough to ask for that because the global cues are indicating that all seems to be well, at least for now, and that's why you've got that 140-odd point uptick straight at the word go. Of course, with the open like that, it gets a little complicated, but I would say that, you've got so much going in favor, right? FI is selling, if you look at that, that's kind of tapered down to next to nothing. If you look at Friday's figure, in the derivatives market, FIs have started, for the first time on Friday, started to cut their short positions by a little bit, not very much. And of course, globally, the screen is looking much clearer. And this time of the year, which is the end of the year, seasonally is a strong period for markets. So perhaps there is more to go here. But if you're trading, I mean, you want a little bit of a dip at some point in the intraday, you will get that. And that's the time to get in once again. So 140 strong points this morning is what the GIFT Nifty is indicative of. Sonia.
Absolutely. And, we were making this point last week as well, right? As to how this is a classic playbook. Every time there's a geopolitical crisis, the market, of course, unfortunate that the crisis is playing out for so long and there's no ceasefire just yet. But the market is using every dip as a buying opportunity, and that's something that's played out really well. So if you look at it, right, I mean, the GIFT Nifty today is up about 143 odd points, but just map the last, 10 days or so, the Nifty is up almost 400 points from the 26th October low of 18,857. So that's, a big rally that we've seen just from the recent lows that we saw. So yesterday as well, DIs have bought in the cash markets about 400 crores. The FI selling has reduced considerably, so there's plenty of momentum coming in terms of flows as well. Now, a couple of things that I want to watch out for. One is that we've had good quality earnings, barring a few and far between. The earnings have been quite good up until now. SBI's Q2 numbers, the asset quality was best in the last 8 years. Loan growth was a healthy 12.5%. And we've had some other earnings as well that have come through, reported very good numbers, the likes of Interglobe Aviation, strong earnings coming through. It's turned into profitability compared to a loss last year. So, all of this put together is aiding the market momentum. Now, as we know, the global cues are strong as well. This week, the week gone by was a very strong week. So the Dow is up about 5%. The S&P 500 saw its best week since November 2022. Of course, you saw the US bond yields cool off as well. So that has aided sentiment. The important bit is, by the way, the S&P 500 is now up almost 6% in the last 1 week. So keep that on your radar. But this 19,250 to 19,300 mark was a resistance level for the market. And that could be taken out today, given at least the context with what the GIFT Nifty is suggesting as the opening. Lot of big earnings today and through the course of the week. You have Divi's Lab, Bharat Forge, Exide that will be reporting earnings. There's Apollo Tyres later on this week, and then a couple of other heavyweights as well. And of course, we head into Diwali, so there's going to be all of that festive cheer. But it's good to see that, all the dips are being bought. So the bulls are sort of once again tightening their grip in the market.
Absolutely. Now I'm just wondering whether the FIs are going to come back in the market. One of the reasons, the big reason for FI selling was rising US bond yields. And that has reversed, right? As Prashant pointed out, the US 10-year has eased 50 basis points from its peak level. There is the peak Fed narrative. So will that FI selling reverse now? Maybe they will start feeling the FOMO because the Indian markets have done pretty well. So we'll watch for the way the FIs play in the Indian markets in the last 2 months of the year. And we're already seeing some signs of FI selling abating. On Friday, the FI selling was about 12 crores. The day prior to that, it was about 1250 crore. And the day before that, on Wednesday, it was about 1800 crore. And remember, this follows FI selling of 20 to 30,000 crore in the months of August, September, and October. Secondly, that point about where the Nifty opens, the GIFT Nifty is suggesting a start closer to that 19,400 mark, which puts it very close to the 20 and the 100-day moving average at the opening level. 19,423 is the 20-day moving average, and the 100-day moving average is 19,447. And last week, the Indian markets underperformed the global markets, particularly the US. So, the Dow, the S&P 500, Sonia pointed out, was up more than 5%, but the Indian markets were up only about 1%. Today, it's going to be a lot about the earnings, reacting to and watching out for the big ones. And, keep your eye out on even the likes of Nykaa, etc., which report their numbers. Cello World listing is today. It saw a pretty good subscription of about 30 times overall. And there is a new a company which is going to be opening up for subscription, Protean eGov Technologies. And this is an interesting company because it's a company which helps with the digital Aadhaar stack, not Aadhaar stack, but the entire digital public health stack of India. So the PAN card issuances are done by this company. If you want to update your PAN card, get the authentication, that's done by this company. Then your tax filing is done by this company. So, it's a play perhaps on, India's digital stack.
Okay. And
isn't it the same as NSDL?
It is.
It is NSDL.
So
basically.
NSDL was split into their, services, the e-government services, and the NSDL, the depository business.
And the second one is this one.
And this is the second one, which does tax, PAN card, a little bit for Aadhaar, etc.
so this is a big week for the secondary market, right? There's also Honasa Honasa Consumer will be listing on the 10th. So all eyes will be on that after the hefty subscription that Honasa got. All eyes will be on what happens with the listing. So lots happening this week. It's also an earnings-heavy week. It's the last week of the earnings season, so lots to talk about. But on the equities front, first up, we have a comment from Rhythm Desai of Morgan Stanley, who says an event-heavy calendar with potential binary outcomes sets the market up for volatility. After having been less volatile than ever, in his base case, he says the fundamentals are likely still driving equities higher. India remains a top pick in the emerging markets. They are overweight financials, technology, consumer, discretionaries, and industrials, and are underweight on other sectors. That said, he adds the macro trade could peak in the coming weeks.
Okay, well, let's get you some money market views as well. This is B. Prasanna of ICICI Bank, who says that a dovish pause by FOMC and soft labor market data have led to reassessment of dollar strength and unwinding of positions. He says that along with absence of incremental geopolitical risk, have improved risk sentiment for Asian currencies. However, he adds the rupee is expected to underperform with the RBI smoothing volatility from either side. He goes on to say that the rupee is to be relieved from the pressures of a strong dollar and equity outflows in the short term, and should trade in a range of between 82.85 to 83.35 to the dollar this week.
All right, and on the bonds, B. Prasanna says that global yields registered a sharp decline on the back of a dovish pause from central banks in the developed markets supported by weak economic data. He says local bonds, however, underperformed the global bond rally owing to the risk of open market operation sales by the RBI. He said the market would keenly watch for the upcoming inflation prints both locally and globally. He expects the market to consolidate with the 10-year benchmark bond yield ranging between 7.25 to 7.40%.
And we have lots of stock-specific action to track today. We'll get to it in just a bit in our special Top 10 segment. We're looking at State Bank of India, Interglobe Aviation, Vedanta, JSW Infra, JK Cement, Aarti Industries, and Thermax that are on the back of positive news flow. Bank of Baroda, PB Fintech, Delivery are stocks on our radar that are likely to open in the red.
Okay, well, let's just sort of rewind the clock back and look at the US October jobs report, which came in weaker than expected. And this is significant. We had CNBC's Rick Santelli with more details on that report and what it means for bond yields, which have been the driver for global markets. Let's listen.
This is the October jobs report. And of course, we're expecting non-farm payrolls to be around 180,000, 150,000, 150,000. That versus 336,000. There are revisions coming. The cumulative revision over 2 months, minus 101,000. So that 336 turns into 297. Now let's move along, shall we? The unemployment rate, and do keep in mind our last look on the unemployment rate was pretty important because we had 3.8. It moves up again to 3.9. 3.9. 3.9 would be the highest level going all the way back actually to January when we were at 4%. And just for a comparison, we were at 3.7 1 year ago if you look at October of 22 versus October of 23. Now, average hourly earnings up 0.2. Last month was up 0.2. It gets revised to up 0.3. Up 0.2 is basically the lowest levels that we've had going back to February of 22. If we look at average hourly earnings year over year, they're up 3.9%. That is something to, they're up 4.1%, up 4.1%. This is a new cycle low. If you look, since we hit 5% in November of last year, this is the lowest level. And to find a lower one, you have to go all the way back to June of 2021, where we were at 3.9. And once again, just to take a look back to last October, it was at 4.9. So if wages are something that are making many feel a little nervous, especially in light of some of the strikes and some of the settlements and some of the juicy contracts, we do see that it is coming down. It's still much loftier than 3.1 and 3.6 in Feb and March of 2020 pre-COVID, just to put some context to it. Average work week, 34.3. This follows 34.4. 34.3 has kind of been the cycle low that we've had on this move. We've had it several times. And finally, the underemployment rate, which is 7.2, it continues to move up.
All right. Well, that is the view that's coming in from global markets on the bond yield and several other things. Let's take a quick break. On the other side of the break, it's a big opening that's lined up. The Nifty implied opening is up 150 points. So the bulls are back, and how? Lots of stocks will be discussed on the other side with our entire research team. So do stay tuned in. Welcome back. Well, plenty of stocks to talk about and a lot of good numbers. So let's get straight to it. SBI reported its best asset quality in the last 8 years. So the street will definitely like that. Abhishek is here to give us the latest on all of that. Abhishek, morning.
Morning, Sonia. So a beat on our poll with respect to the fact that stress in the balance sheet has reduced massively. Asset quality, one of the best, as you mentioned, in last 8 years, coming in gross NPA ratio of 2.55% when compared to 2.76% in the previous quarter. The watch list is the lowest in last 13 quarters, coming in at 0.12% of the book. NCLT list is also one of the lowest in last 18 quarters, coming in at 5.2% of the loans versus 5.34% in the previous quarter. Even the restructured book is one of the lowest in last 12 quarters. International loan growth, that increased by 9% sequentially, one of the best growth rate that you are seeing in last 5 quarters. Now the loan growth, overall loan growth of 12.3% YOY and about 3.25% quarter on quarter, slightly better than analyst estimate of 12% YOY and 3% quarter on quarter. ROE continues to remain about 20%, which augurs well for SBI. In terms of their numbers, both the ANA and PAT is a beat on our poll. Back to you.
All right, thanks a lot for that. Well, the other stock that we're looking at this morning is Interglobe Aviation. So just want to get straight to it. Very good set of numbers coming in from Interglobe Aviation this time around. Across the board, actually, the numbers have looked good. The revenue growth has come in at almost 20%. There was a strong growth in the margins, as you can see on your screen. In Q2, the EBITDA margins are 16.4% compared to 1.8% same time last year. And the company has now reported a profitability of almost 189 crores compared to a big loss of 1,600 crores last time around. Now, if you look at the internals as well, the capacity of the company has gone up by almost 28%. It has been a very good quarter, you know, seasonally. I mean, you can see it all around, right? The aviation space has just sort of blossomed in the last couple of quarters, come back in a big way. Passenger growth has been healthy. Almost 35% passenger growth is what we saw this time. Yields, though, they declined for the company, down about 12.5%, but the load factor has improved for the company, up about 4.1%. The company also expects to increase their capacity further by 25% year on year in Q3. The only problem is the debt of the company has gone up. So the debt has risen by 20% year on year and now stands at a little under 50,000 crores. However, most brokerages are very upbeat with the improving numbers. If you look at UBS, they have a buy with the target price of 3,000 on the stock, well above the current market price. And Goldman Sachs as well has a buy with a target price of 2,700. So I'm going with green on that name.
And these numbers, Sonia, with oil where it is, right?
Yes.
I mean, which has been high, on the higher side in the quarter that we're talking about. Well, so that's a good set. Vedanta is the next one we want to talk about. Vivek has got details on the numbers here. Vivek, hi, morning.
Well, good morning. A complex set of results to pass through, but you know what's actually happened is that the street was going in with muted expectations, but the company has managed to beat those expectations. Multiple one-offs, we'll take you through them. Top line, the revenues are higher by 6.5%, aided by a one-off of 6,400 crore. This is on account of favorable outcome of arbitration as far as the oil and gas segment is concerned. So the adjusted revenues lower by 6%. The adjusted EBITDA is down 8%, coming in over 7,079 crore. The EBITDA margins on a year-on-year basis have expanded over 220 basis points. On the bottom line front, or on the profitability front, there has been a net loss that has been reported of 915 crore. Two one-off items. Number one, an exceptional gain of over 1,200 crores. This is on reversing previous write-off as far as the oil and gas division is concerned. But you know, the larger number that we need to keep an eye out for is the tax figure. The tax that the company has paid this time around is in excess of 9,000 crore, which was substantially higher as the overall tax was inflated by 6,100 crore, given the fact that the company has adopted a new tax regime. Segmentally, oil and gas reported EBITDA at 5,860 crore. The adjusted EBITDA of 1,470 crore is better than estimates. And lastly, talking about the aluminium EBITDA, 1,967 crore versus a Nuvama estimate of 1,747 crore. So both of these segments have done better than what analysts were anticipating.
Okay, thank you very much for that. Bank of Baroda also reported their numbers, a bit disappointing on the margin front. Abhishek joins in with the details. Abhishek.
Well, Rima, as you mentioned, you know, the net interest margin has been a big disappointment for Bank of Baroda, given the fact that it's perhaps the only PSU banks, large cap PSU banks, which has actually lost 46 basis points on net interest margin in the last 2 quarters. So the net interest margin is a decline of 20 basis points quarter on quarter. Q1, it was about 26 basis points quarter on quarter. Net interest margin guidance for FY24 has been cut to about 3.15%, plus or minus 5 basis points is what the management has mentioned. This was was earlier estimated at 3.3% in terms of FY24 net interest margin. Slippages have increased to 4,751 crores versus 2,761 crore. This was on account of, one of the aviation sector, which contributed to about 1,774 crore in a single account in aviation sector. So asset quality continues to improve. That is on the account of write-off being on the higher side. Gross NPA ratio is one of the best in last 34 quarters, coming in at 3.32% versus 3.51% in the previous quarter. Annualized credit cost on account of the one-off slippages that they have had is at 6-quarter high of about 0.9%, but remains well below the 1% level. CASA ratio, as you are seeing with the industry as well, that the CASA ratio is declining. It's now declined for Bank of Baroda as well and is below the 40% level for the first time in last 12 quarters, now at 39.9% versus 40.3% sequentially. So in terms of NII, it's below our poll. However, other income has aided the PAT this time around, beating our poll. Back to you.
Okay, thanks a lot for that. So that's on Bank of Baroda. But let's hop across to Vivek. He's tracking JSW Infra now. Vivek, over to you.
Well, that's right. It's a steady set of numbers from the company this time around. India's second largest port operator. Revenues higher by 28%, largely aided by cargo handle volumes up by 27% on a year-on-year basis. The reported EBITDA is up 32.5% and margins too have expanded 200 basis points for the company this time around. Profitability higher by 85%, largely what the street was penciling in given the management commentary post the IPO. Two very interesting acquisitions. Number one is outside of India, the Fujairah Port Terminal. The current capacity utilization of 95% at this particular port, and the company has paid a total enterprise value of $187 million, which values this particular terminal at 8.5 to 9.5 times EV to EBITDA as far as FY24 is concerned. Interesting acquisition there. And the second one, the company has gone ahead and acquired a cargo terminal operator license, and this is from Sickle Logistics. So another interesting acquisition. The management will join us later and we'll quiz them more on these two acquisitions.
All right, that's the second largest private ports operator. Vivek, thanks very much for that. And as you said, we'll hear from the management in a bit from now. PB Fintech. Zomato, we will talk about more. The reported numbers on Friday, and numbers were good. PB Fintech reported numbers as well. Surabhi's here with how they looked. Surabhi, morning.
Good morning. So, it was a strong top-line growth, but the profitability has deteriorated on a sequential basis. So, the revenues were up 42% on a year-on-year basis, and the growth is coming from both Policy Bazaar and Paisa Bazaar, and the new initiatives that is growing at over 30% on a year-on-year basis. Now, the adjusted EBITDA profit was at 13 crores versus a loss of 53 crores same time last year, but the Q1 profit was 23 crores. So, losses have EBITDA profit has gone down sequentially. Adjusted EBITDA margin of 2%, and in Q1 it was 3%, so 100 basis points contraction there, and a net loss of 21 crores versus a loss of 187 crores in the same time last year, and Q1 losses of 12 crores. So losses have expanded sequentially. So good revenue growth, but profitability deteriorated on a sequential basis.
Okay, thanks a lot for that. Well, JK Cement is also what we're looking at this morning. Let's find out how the numbers were. Vivek, over to you.
Well, after the positive surprise delivered by JK Lakshmi Cement, last week, JK Cement too has surprised quite positively. Volume growth has been very strong for the company in Q2. So when you're talking about the sales volume, it's up 22%, amongst the best as far as the cement universe is concerned. The grey cement volumes too up 22% on a year-on-year basis. Revenues from operations up 23%, largely aided by volume growth and good price realization as well. Q2 FY24, revenues coming in at over 2,750 crores. Now, talking about the operating profit of the EBITDA, it's up 51% on a year-on-year basis, and on the back of that, EBITDA margins have expanded by 220 basis points. Profitability higher by 61%. This will be a stock to watch out for, going with a green on this particular name.
Okay, all right. Vivek, thank you very much for that. Well, we're talking about new age companies, and delivery is the next one, which is in focus. The stock is just about 10-15% away from its IPO price. It didn't fall as much as the others, and we got the second quarter numbers here as well. Mangalam, take it away.
Well, the second quarter numbers for delivery were soft, and that was expected largely on account of the shift that we saw in the festive season into the third quarter itself. And there has been a strong start, understandably, to the third quarter. So just to run you through the second quarter numbers, the revenues were absolutely flat quarter on quarter, close to around 1942 odd crores on the top line. The EBITDA was still loss-making, close to around 15.5 crores. And as a result of which, the company reported a net loss of 103 crores on the bottom line. But there are a few internals which will allow the stock to be supported at lower levels and perhaps recover from lows as well. The first one is that they're still having cash of almost 5,500 crores on their books. Their net working capital days have reduced from 38 to around 28 as well. And they've spoken about the third quarter volumes. October volumes are at 70 million plus parcels, and this compares with the second quarter volumes, the entire quarter, at around 181 million. And plus, they've got multiple order wins in the second quarter from existing and new clients, and they are expanding their network across all functions that the company operates in. So as a result of which, the stock opens lower, but from there, we see a swift recovery.
Okay, thank you very for that. So right shifting of the festive season has hurt delivery this time, but perhaps it will catch up on the numbers in Q3. Sonal is here for more on Aarti Industries. Sonal.
Thank you for that. Well, on a YY basis, it was understandably a weak quarter for Aarti Industries like the other chemical companies. But on a quarter-on-quarter basis, there's a surprising recovery which the street would like, considering that it's the only large specialty chemicals company to see a quarter-on-quarter recovery. Revenues on a YY basis down 14%, EBITDA down 13%, margins at 16%, leading to a profit decline of 27%. But the quarter-on-quarter recovery is something that is a positive, because then the revenues are up 3% on a sequential basis. EBITDA is up 16%. Margins are up 200 basis points, leading to a profit growth of around 28%. The call is at 4 p.m. today. We'll get in more details as to what the demand is looking like, but going with green on Aarti Industries for today.
All right, going with green on Aarti Industries. Thanks a lot for that. Well, Upasana is also with us. She's going to tell us how Thermax's numbers looked this quarter around. Upasana, over to you.
Well, all in all, we are seeing a good set of numbers coming in from Thermax in its Q2 FY24. Talking about the revenue from operations, it saw an uptick of almost 11%. Other income saw an uptick of almost 65% at 66 crores. And EBITDA stood at 231 crores with an uptick of almost 59%. Talking about the margins, the EBITDA margin saw an expansion of 300% from 7% to 10%. In terms of PAT, it stood at 158 crores with an uptick of almost 45% on one-year basis. And order book also saw an uptick of 8% at 10,264 crores. Well, talking about the segmental revenue, the industrial segment clearly outshined with a revenue uptick of 18% at 989 crores, and EBITDA margins for this segment expanded from 7.8% to 10% on the back of stabilized commodity cost is what the company has stated. So all in all, we are seeing a good set of numbers coming in from Thermax in its Q2 FY24.
Okay, all right. Thanks a lot for that, Upasana, and thanks to our entire team. Here's a quick recap of our top stocks with positive news flow. There's SBI, Interglobe Aviation, Vedanta, JSW Infra, JK Cement, Aarti Industries and Thermax, while stocks with negative news flow, there's Bank of Baroda, PB Fintech as well as Delivery. But there's also lots happening in the world of commodities. Manisha Gupta is joining in for a roundup of all the action there. Manisha, good morning.
Morning, and thank you for that, Sonia. Well, the US dollar and the Treasury slipping post the weak US jobs data that we saw come in on Friday. There is some support that you've seen in crude and in metals as well. The crude oil prices have edged higher. We did see prices post a 6% decline in the previous week, but this week, has started on a positive note. Same is the case with metals, 3 to 4% on the higher side, week-on-week basis.
Okay, all right. Manisha, thanks very much for that. We'll take a very quick commercial break here. Prakash Devan will join in. We'll sort of toss to him some of these earnings which have come through and how stocks should react. We also will have the management of Aeroflex Industries to talk about their second quarter earnings. Stay tuned.
Welcome back. Expect a solid start to the trading session. Given the buoyant global cues, the Korean markets are up 4% after the short-selling ban till June of 2024. Japan has opened up after a day's holiday on Friday, and it's opened up with strength. And other markets like Taiwan, Hang Seng, all holding up with gains of close to about 1 to 2%. The GIFT Nifty too is suggesting a very strong start. Prakash Diwan is here with us on the show. Prakash, two PSU banks will be in focus today. One is State Bank of India and the other one is Bank of Baroda. Now, given Bank of Baroda has outperformed State Bank of India by more than 40% in the last 1 year, are you expecting it to start underperforming? What should the play be if someone holds Bank of Baroda in their portfolio? Should they look to switch it to any other PSU bank?
Good morning, Rima. That's a very interesting question. Because what's happening is now that the banking results season is kind of done with the big daddy SBI also telling you that this is where we are in terms of quality, in terms of NIM growth, in terms of credit growth. It's very important for people to assess that Bank of Baroda did extremely well in the recent past, because after SBI, PNB, you have the second bracket bank, which is Canara Bank, BOB and Canara Bank in that order, if you will. And within that, Canara Bank probably started seeming a bit pricier. And then that's where people latched on to BOB. So it was more of ownership and the kind of holding pattern that decided most of the outperformance that you mentioned. But if you actually look at a longer term growth where SBI is kind of flexing itself to leverage on all those 3-4 verticals that any large bank would be able to get growth from, I think SBI's run is yet to begin. So in my understanding, SBI will probably outperform, but it's a giant of a balance sheet. It will take time to kind of give you those incremental returns, which a much smaller Canara Bank or BOB could have done. But I would believe Bank of Baroda will probably have to reset itself. Give them 2 quarters; they'll take that kind of time to come back. But SBI, with the quality concerns out of the way, growth looking very strong, I think is definitely underrated. In terms of price as well. So I would believe there's much more to go for SBI than BOB for sure.
Okay, separating the men from the boys, right, Prakash? Like you always do. Thanks for that. Well, good morning. I wanted your thoughts on Interglobe Aviation. Good set of numbers coming through. But, the stock has also rallied about 40% in the past 1 year. You think a lot of the good news is in the price?
Good morning, Sonia. No, not at all. I think Indigo is looking at a situation where it not only has made a comeback from those COVID-impacted lows on all metrics, whether it's the CASK and the RASK, it's also the EBITDA. It's look at where they have made a lot of changes. So it's not just revenue growth, but they've managed to keep their costs much better, much more efficiently controlled than what they were doing at the pre-pandemic levels. And if you notice some of the changes that they've made, they've 2 things. They've added a lot of routes which will take time to stabilize. I mean, you have now 85 destinations from which it flies to and fro, and in more than about 1,000 flights a day. So with that kind of a scale, and with the rest of the players like Go First and Spice vacating a lot of space, there is so much that they have in terms of pricing power, Sonia. The other thing that's changing, I think, is an overhang on the promoter selling. Is where I think the stock got impacted, and it's been a lid of sorts on the stock price. These results, given the kind of seasonality that we are seeing, crude not going as berserk as we thought, all of that kind of could play out, and you'll have a very strong run in the stock, at least in the short term. Of course, in the long term, it will get tied in with the secular growth story. And remember, airlines do well if new airports come up. It's not about new planes. It's not about this thing. There's always a potential traffic, but then you need airports. So it's like, Maruti did well because, roads came into India 20 years back. So that's the whole pattern that's emerging. I'm quite positive given these metrics for Indigo.
Okay, quite positive given the metrics for Indigo. Let's talk about a company that is called Aeroflex. So it's our first corporate interaction. So Prakash, just stay on for a bit. Aeroflex posted a good set of earnings for Q2. The revenue saw healthy growth year on year, while the margin surged about 360 basis points. Asad Daud, who's the managing director at Aeroflex Industries, joins us now to talk about that. Well, Asad, thanks a lot for joining in. It was a good growth for you on the top line, 24% year on year growth, although sequentially the growth was flat. Can you take us through what the trajectory is in terms of the second half of the year, and what are you looking at by the end of FY24, what kind of top-line growth can you eke out?
So, first of all, thanks a lot for inviting me. So, generally, the first half of of the year contributes about 40 to 45% of our overall sales, and the second half of the year contributes about 55%. So, if you extrapolate our numbers, so we would be in line with our targets for the current FY.
Could you just tell us what the target is for FY24 in terms of top line? What's the revenue growth? In H1, you've done 21%, 22%. Considering H2 is stronger, can you head to a revenue growth of 25%? And what about on EBITDA margins? What's the number we're looking at for the year?
So in terms of the growth, so as compared to the last year, we are expecting at least about 30 to 40% growth overall in terms of the top line. And in terms of the EBITDA margins, as you have seen that as compared to the last year, our EBITDA margins has been growing continuously quarter on quarter, and we are expecting anywhere between 21 to 22% for the entire year.
Okay, so 30 to 40% growth on the top line is what you're looking at for the full year, and 21 to 22% margins is what you're hoping to eke out. Got it. I do understand that 85% of your business comes from the export market. So can you tell us a little bit about that? Are you seeing a slowdown in any geography? If yes, which one? And what's the outlook for the next 1 year in exports?
So yes, majority of our sales is from exports, and exports is showing a strong demand so far. And in exports, primarily our exports is to the USA and to the European region. And so we are continuously focusing on the USA because that is a very big market for us, and we are seeing a strong demand from there. And over the next 1 year, we expect to maintain our ratio of 80 to 85% of sales from export and about 15 to 20% sales from the domestic market.
Okay, all the best of luck for you, Asad. Great speaking with you, and thank you very much for joining us here on CNBC-TV18. That's Aeroflex Industries. Prakash is still with us. Prakash, we're going to talk about Zomato, which came out during market hours, and there is a great deal of excitement about this one. So what's the sense? I mean, there are those, for example, I was reading a note by IIFL who was saying that it's juiced out at current valuations, but there are others who believe that it's only the teaser, and the potential is large. It's a felt need, and we all know the fundamental drivers for the business from here on. But it's a matter of valuations, etc. So your call.
No, good morning, Prashant. So very interesting juncture that Zomato is kind of clobbered itself to come to, and given what PB Fintech and Delivery and Nykaa are doing, so this post IPO drop that we had seen, the bad boys club, if you will, I mean, it's just in a lighter way. They were always struggling to even come above the IPO levels, and Zomato's probably breasted the tape. So that's the change that's going to happen. So all that distress selling that you saw, all that overhang in terms of large PE exits, is out of the way. So what will happen is it will now stabilize at a higher PE multiple, given the long-term secular story that the narrative that it's kind of building up. And remember, Swiggy's weakness in the market is going to be significantly beneficial for them. Of course, there are a lot of disruptors that could come along the way and try and make things difficult for Zomato to get its pricing power to inch up. But at the moment, Prashant, I think if you ask any restaurant owners, any network players, all of that is leading to a very simple scalability and operating leverage coming at some point in time. So I think the stock should do well. There won't be much of selling pressure. It's kind of turned the corner, and that's exactly why you won't see supply coming into the market on the stock. So I think at about 115, it's kind of not very, it's not valued at a value buying kind of a zone, but I don't think it's even expensive. So it's in middle of the path. Depends on what you look at time horizon wise, but I think it will do well from here on.
Okay.
Right.
By the way, we have Nykaa's numbers today. So after the strong showing from Zomato, let's see what Nykaa does. The expectation is that the beauty business could have a growth in 30%. Let's see what the fashion business does. But Anuj is joining in now for a quick trade setup. Anuj, hi, good morning. It's, all guns blazing. Markets are doing well. India is doing amazing and in cricket. So no complaints.
Absolutely no complaints, Sonia. And, the only worry sometimes we have is if you're peaking too soon. But I don't think that is the case. But anyway, let's look at the trade setup. I think the Nifty has made a new series high. And normally when you do that, right after the first week, you have a trending series because the market tested the lows and the market defended that and moved on. So now the market will move on the other side. Now, there was this fall from 19,800. So there are two levels to watch. First is the 50% retracement zone, which comes in at 19,334. And then the 66% retracement, which comes in at 19,493. If you sustain about 19,493, then my sense is you can go back to even 19,800. SBI's numbers look quite strong. So it's possible that that could fire the Bank Nifty today. Also, the global Q is looking very strong, especially the way US bond yield has collapsed. It was at 5%. It's come crashing down to 4.58%. And that's led to that big move in Dow Jones. Now, if you look at the domestic setup, what's very interesting is the kind of move that we are beginning to now see from FIIs in index futures. Because when we started the series, we were at 90% short. Now, on Friday, there was buying of 1,000 crores, and that was evenly divided between Nifty and the Bank Nifty. The next page will show that Nifty, there was buying of 535 crore, and Bank Nifty, there was buying of 479 crore. And if you look at the open interest change, on the Nifty, there was an open interest cut of 3.5%, and on the Bank Nifty, open interest cut of 6%. What's that telling you is that there's short covering which is happening now from the FIIs. That's more visible in the next plate. If you look at the longs and shorts, they've added 3,800 longs and they've cut 9,200 shorts. So net, there was a cut of 13,000 short positions. We were at 1.8 lakh contracts, almost all-time high net shorts. That's come down, even in percentage terms, from the peak of almost 90% short, we're now down to 82% short. And 82% is still heavily short. So there's a good chance that after today's gap up, there's more short covering. Purely in terms of levels to watch for today, the first resistance is 19,423, which is your 20-day simple moving average is placed. Then, of course, 19,515 going by this week's options contract. On the lower side, the support after gap up would be 19,230, which is Friday's close, and then 19,130 based on the put options. I think the Bank Nifty can be very interesting from here. Till now, the Bank Nifty is underperformed, but first signs that the Bank Nifty could be beginning to outperform from here came on Friday. The Bank Nifty reclaimed the 200-day moving average and closed above that. And it's possible that it now leads the next round of rally from here on.
Okay, well, Anuj, thanks very much for that. So, it's looking good. It's looking set up for higher and higher levels. Just one thing, there is, from tomorrow we get into the state election cycle as well. Tomorrow is the 7th, and I think Chhattisgarh goes to polls, and then, of course, there will be Madhya Pradesh, Rajasthan, Telangana, of course, Mizoram, etc. as well. So we get into the politically hot season as well. We'll take a very quick commercial break here. We'll come back. We have Mitesh and Sudarshan joining in with what they're making of things and the trade setup they want you to follow. Stay with us. Okay, welcome back. I think the GIFT Nifty should come up on your screen. There is still about, 9 minutes to go for the market open. And I think it should give you a sense of where we are likely to start. I mean, the 20-day for the Nifty is at about 19,424. The GIFT Nifty is sort of implying an open basically around those levels, 19,443 or so. Is where that is implying an open. So at the 20-day, if you open around at the 20-day, what do you do? Mitesh and Sudarshan are with us with exactly the thought and, of course, advice on what you need to do. Gentlemen, good morning. Great to have both of you here. Sudarshan, let me start with you. What's your sense? It's looking strong. It's looking up. But with a big gap up, it becomes a little complicated. Your sense?
Yeah, good morning. With a big gap up, it becomes difficult for intraday traders to enter. Those who have long positions should maintain them. But we must also remember that the Nifty is now entering a zone of very strong resistance. That's about 19,350, 19,400. So the trend, the short-term trend is up. We should be looking to buy into sharp dips. Now you have to be patient to get these sharp dips, but they come. It's not as if they will not come. You just can't go and rush into the market to go long. Then that becomes a losing trade. So wait patiently, you will find intraday dips, big dips, then you go long and keep a tight stop loss of about 100 points.
Good morning, Mitesh. What would your Nifty approach be this morning after the gap up open?
Morning. So, last few days I've been advocating that the market will stop falling and possibly become volatile within a range of about 19,250 to about 18,850. And we on Friday closed right around the 19,250 mark. Now today with the gap up, I think there'll be range breakout. But with the rally of the last 3 days, it will not immediately invite a long positions purely because the risk reward equations on the intraday charts, because the price has now moved away from the intraday averages, will be slightly unfavorable. So the way I'll approach is one, as Sudarshan said, buy on declines. But we have been trading with long bias stocks. So the Nifty target, which I'm looking at now, is around 19,450, 500. Around that area, we'll want to take some profits off the table and see how it goes from there. But if it starts going beyond that, then I think we are penciling in 19,650, even 19,800, 850 zones eventually. But for the timing, we'll take one step at a time. I think we'll go with a working target of 19,450 to begin with.
For individual stocks, what are we looking at? Sudarshan, let me begin with you. Good morning. What's your stock list? And also, what do you do with a name like SBI? Good numbers coming through. Do you expect more upsides?
Good morning. Yes, for SBI, I would expect more upside, significantly higher. That's for the short term as well as for a positional trader. So that's a trade where actually, Sonia, you want to buy this stock and keep it till the end of December if you have the patience. But otherwise, yes, buy anytime. Bajaj Auto is a buying opportunity. That stock has been having a significant rally. It had a small trading range when the Nifty was falling. Buy with a stop under 5,200. Coal India is another big rallying stock. Small consolidation, outperforming the Nifty. Buy with a stop under 300. Dalmia Bharat is my only intraday short. That stock has fallen and collapsed from a large distribution pattern. It's an intraday short with a stop above 2,100. And finally, I have a relatively high risk trade in a very good quality stock, Infosys. Now that a very small consolidation has broken on the upside. That may not mean anything, but it's worth finding out. So buy it. Keep your risk low, but buy with a stop under 1370.
And what about you, Mitesh?
I have all buy calls as well. Very clearly, this market, should be trending on the long side in the near term. So I have a buy on Godrej Consumer Product, which gave a strong reversal candlestick on Friday. Keep a stop below 1,003. Look for targets of 1,060. Gas Authority also, I think, managed to get past key intraday pivots. So this could see continuation. So GAIL is a buy with a stop at 122 for targets of 128. Good chart pattern and signal on the chart of Apollo Hospital. So that's a buy with a stop at 5,100 for targets of 5,300. And the last call is on L&T Finance. Disclaimer that I have some futures positions, so there is vested interest. That's a buy with a stop at 138 for a target of 147.5.
Okay, gentlemen, we need to slip into a very short break. We'll come back with the pre-opening rates. We'll also be joined with Arun Maheshwari, Joint MD CEO at JSW Infra, to discuss the company's Q2 performance and their business outlook. Stay tuned. Welcome back. This is Open Exchange live from the CNBC-TV18 Motilal Oswal studio. Let's invite the management now of JSW Infra. Now, the company reported a good performance in Q2. There was a healthy surge across parameters. The management has also guided for a stronger second half versus the first half. The stock has also done pretty well since its listing. It's currently trading at about 171, which is at a premium to its issue price of 119. We're joined by the company's joint MD and CEO, Arun Maheshwari, to talk about the way forward. Thank you very much for joining in. Before we talk about the second half, could you just give us an overview of the quarter gone by? How were the volumes? Where do we stand in the first half versus H2? And then if you could guide for the second half of the year in FY24.
So if I had to look only at Q2 of FY24 with respect to Q2 of FY23, the overall volume has grown up by 26%. The revenue has grown up by 29%, and the EBITDA has grown up by 33%. EBITDA has been largely higher because of the higher base of volume, and thereafter the operational efficiencies have kicked in over there. If I had to compare H1 to H1 of FY23 vis-a-vis HY24, the total throughput volume has been 17% up, revenue has been 16% up, and the EBITDA has been 17% up. So it's all in tandem, basically. So typically, one thing which we must note about that in India, the monsoon is very heavy, especially on the west coast of India. It's very, very heavy in Q2 of any year. Generally, the volume tend to go low. Historically, we have seen that H1 is slightly lower as compared to H2. So we will be witnessing that as we move forward. H2 is likely to be slightly better than H1.
No, got that. So, we've seen a few big-ticket acquisitions really coming through. So, for the Fujairah acquisition, you paid top dollar according to analysts, which is, which some are saying is expensive for a 95% utilization asset. What is the rationale here, and what could be the strategic gains over a period of time for the company?
We were never into liquid in a big space, and we wanted to get into liquid terminals. Fujairah is one of the top 3 business centers for liquid terminals across the globe, and we have been having a presence in Fujairah area for a long time. And we have a comfort zone, and we got this opportunity over there to acquire one of the assets over there. Of course, it is running at a higher utilization today, but there are growth opportunities within the same terminal. There's an additional land available nearby which we can acquire, and we can build the terminal much more. We can bring operational efficiencies over there. This is a first foray into this kind of terminal business. Once we have a hands-on onto this terminal business, which is very, very safe zone to get into, thereafter, we can expand our business presence within India as well on the oil tankage terminal side. So this has been our strategy to just go slow, go small in one of the terminals or one of the business line, and thereafter grow from there on once we have experience on that. That we have experience in container, that we have experience in LPG, that we have experience in sugar. Now we are getting into oil tankage terminal. So this has been our strategy.
So the Sikar Logistics acquisition is interesting. How much are you paying for this asset? How much does it add to your books? We understand that it adds an important license to your kitty as well. Tell us a little bit about that.
Again, this particular acquisition is largely for getting into the last mile connectivity with the customers. We have not been into this space since our inception of the company. We have been into very dedicated manner. We have not been that open for any customer at any point of time for last mile delivery. This one particular thing which we were missing in our system, and we wanted to have an experience on this. So we have gone into the CTO license which was available, and we could negotiate, and we have finalized it. Now, by virtue of this, we would like to get connected to the customers directly from our port terminals and places. So this is one step towards getting into that missing link between the customer and the port. This is again as our strategy always goes, like go small, experience it, and thereafter go big if you find it really very accretive. We feel this has been our strategy in all our products, and this has really paid us well. This justifies what our investment rationale going forward as well. So this is one such step again towards connecting the customer and the port.
So what about the SP Group arm, Gopalpur Ports? Is JSW Infra looking to buy that for about 3,000 crore rupees? Or is it an asset that you will evaluate if given an opportunity?
See, we are the second largest port operator in India, and definitely, any opportunity within India, outside India, good lucrative opportunity keeps coming to our desk and doors. We keep assessing several opportunities, and not necessarily that we'll go ahead with all the opportunities. But as of now, being a sensitive matter, and we have been into NDAs with several other companies, so we would like to leave it over there. And as the time passes, probably we can talk more about such opportunities.
But if you can give us a sense, I mean, which are these other assets? Are there several in sight, and just in terms of opportunities?
Being a big company with a good cash flow and a good appetite to grow, so several opportunities keep coming to us. We keep assessing those opportunities. It's not that we don't assess the opportunities, but how far we would be serious and how far we will go on these opportunities, it's only our assessment which will come out. Then we'll take a call on that. So as of now, we are not into any of those stages per se.
All right. Could we also try and understand what are the targeted EBITDA margins in the longer term? If you can, give us a comparison versus some of your larger peers, and what are the other capex plans that you have in place right now?
As comparable to any other greenfield port in India today, we also get close to about 65% kind of EBITDA margin in the greenfield ports. Wherein in the terminal, depending upon the revenue share, we get our EBITDA margins. A blended average, if I have to look at it, is close to 53 to 55% kind of EBITDA margin. If I have to take out the revenue share, assuming there's no revenue share, our EBITDA margins are close to 65% on all the assets. So it depends. It's a purely play of EBITDA margin, depending upon the revenue share what we have. Having said that, we largely are guided by the return on capital employed, not by the EBITDA margin. If you see our ROCE till FY23, if I have to look at the ROCE, it's about close to 20%, which is quite healthy in this industry. With having almost nil debt as of now, net debt to EBITDA is almost zero. So considering 20% ROCE going forward, it is going to go up if I don't do anything further from here on. So we are largely guided by ROCE.
And one final question, sir. Given the strong inorganic growth plans, the expansion, is there a capex outlay number that you have in mind, or any, the net debt to EBITDA levels that you're comfortable with?
See, capex plan would be guided by our internal target of net debt to EBITDA ratio, what we would like to keep. We have taken an internal guidance that we would not like to breach 2.5x net debt to EBITDA. So today we are net debt is zero. So we have good enough headroom to go ahead and do more and more capex. India is offering such opportunity. We have a healthy balance sheet, and we have an appetite to grow, as I said earlier. So this gives us enough headroom to keep on spending the money. If we have to talk about FY24, with these two acquisitions, assuming we don't do anything in the rest of the year till March, our net debt to EBITDA would still remain below 1, or rather still be 0.5 kind of numbers. It is most likely to be that. So having said that, we have good enough margin available to keep on continuing with a capex plan, keep on expanding and growing our business from here on.
All right, good conversation, sir. Thank you very much for your time. That's JSW Infra in focus. Now, let's just get back to stocks and earnings, right? Prakash is still with us. By the way, we discussed so many earnings which have come through post-Friday and over the weekend, etc. as well. And there is a common thread. There isn't very much by way of earnings upgrades, right? Stocks move based on earnings surprises, both up and down. And if you look at whether there are any upgrades to consensus earnings expectations, or looking at various notes, etc., there aren't very few. I could only actually look at Indigo, which has seen some upgrades because numbers have beaten expectations. So just to kind of rewind the clock back, I looked at we had about 50% done, actually more than 50% done with this earnings season. If you look at the NSE 200 group of companies, these are the top 200 companies up on your screen, and 58 companies out of the 100 have seen FY25 earnings being downgraded over the last 1 month. Earnings season is 1 month old. And since the time the earnings season started, 58 out of the 100 top companies have seen earnings being downgraded for FY25 1 year forward. Only 39 have seen upgrades. Quickly to take a look at the upgrades and downgrades, they're on your screen. IOC, BPCL, HDFC AMC, HDFC Life, JSW Energy has seen a double-digit earnings upgrade. Dr. Reddy's, Maruti, Dixon, KPIT are some of the others which are up on your screen. And which are the top downgrades? Chemical, UPL, SRF, Naveen Fluorine have seen downgrades. Loris Laboratories, Syngene. Look at ICICI Pru and Max Financial. So insurance comes up strongly. JSPL, there is Tech Mahindra, which has seen some sharp downgrades. Banks have seen downgrades. Federal Bank, Kotak Bank, HDFC Bank, Adani Wilmar, Jubilant Food, QSR, of course. We had the management of Sapphire on Friday. Now, it doesn't look all that great. Names like Tata Communication, Petronet LNG, Sona BLW, Emphasis, these are all seen downgrades. The point being that even though company earnings for the quarter may seem good, okay, what matters is upgrades or downgrades to where the street already is in terms of their expectations of what earnings will be in the future. And there we are seeing more downgrades as compared to upgrades at this point in time. I think Prakash is still with us. Prakash, quickly, any thoughts, any names strike out to you?
But interestingly, you look at, the upgrades are across the board in the sense they are across various sectors, I would say across the board. So you've got energy, you've got some of these auto names, so it's not that, and of course, while insurance has been struggling, some of the insurance players like Max and I have struggled, and PB Fintech numbers corroborate that. HDFC Life has got an upgrade. So what I'm trying to tell you is that it's very stock specific at the moment. And the chemical segment is the one that I would really look at. With the numbers that Aarti Industry gave out, I can tell you anecdotally, I spoke to a very large chemical player, and what they've done is the softness in demand has brought down capacity utilization. They've utilized this period for a lot of debottlenecking, a lot of upgradation in their processes. And, once that demand starts picking up, the bottoming out will actually start getting into a very different positive, favorable zone. So, I think earnings tell you what not to buy more than, what to buy. And from that perspective, things that have peaked out are the ones where you probably see some pain or some sort of consolidation. But things like chemicals, where there is a very clear bottoming out, and the large companies which are utilizing this softness in demand trajectory to actually invest and look at gross block improvement in some of these companies. In spite of reduction in demand, they've done quite well on that front. So which means that they're gearing up for the restocking cycle. And as and when that happens, it could be a quarter or 2 quarters away. But that's the nature of the business. So I would look at earnings from a slightly more positive perspective. What's soft, what's got downgraded will actually give you entry points to get in. So chemicals is probably the standout sector in this quarter from a very clear indication of bottoming out.
Hey Prakash, thanks a lot for joining in. We're heading into the market opening. So let's talk about Zomato, where brokerages are very upbeat there. Mangalam has more details. Mangalam, over to you.
Well, Zomato did extremely well in trade on Friday, post the numbers. And post that as well, there have been a lot of upgrades. So expect the up move to continue on that counter. Jefferies, for instance, says that there has been a comprehensive beat which has driven meaningful upgrade on both the revenue as well as the bottom line. Overall GMV growth of 47%, closer to 11,500 crores is what they like. Blinkit has turned contribution positive, and that was the key takeaway from the numbers this time around. Zomato Gold, which is their loyalty program, is now 40% of the GMV for Zomato, and this compares to 33%, so that's firing well for them as well. And in a few cities, Blinkit's GOV is actually better than Zomato, and as a result of which, the management is actually on track to deliver Blinkit EBITDA break-even by first quarter FY25. In fact, they've retained a buy with a revised price target from 130 to 165. HSBC too has said that the third quarter guidance is extremely strong, high single-digit growth for the foods delivery business because of the World Cup and the other things that we have in the third quarter. They have a target price of 140, and Morgan Stanley also with a target of 140. They see upside risk to their estimates going forward.
Okay, thanks a lot for that. Well, we're heading into market opening now, just about less than a minute left. And it looks like it's going to be a solid opening this morning, 0.6% higher. I think Sonal is waiting by to tell us about the chemicals industry. Sonal, over to you.
Well, yes, there's a Morgan Stanley note on the chemicals industry, and they have upgraded and downgraded a few stocks. But let me start with what they say in the note. They say the chemical earnings have reset by 25 to 30% from the peak. Last 2 financial years did see abnormally high or supernormal profits, but global inventories are now rapidly threading lower. And global crop care and chemical companies, they expect some recovery to come by in the first half of calendar year 24. They estimate $1.2 billion of investments will be monetized in next couple of years within their coverage. They've upgraded SRF and Aarti Industries from overweight to an equal weight, to an overweight from an equal weight, downgraded Naveen Fluorine to an equal weight, and double downgraded PI Industries as well. So that's why these stocks will be in focus.
All right, thanks a lot for that. Well, here's the market opening, by the way. The Nifty is up almost about 100 odd points. Very good opening, actually, for the market. The sensex is up about 320 odd points, so looking pretty good at the start. The Bank Nifty is up 165, now 175 points higher. So very good opening there, in line with what the Gift Nifty was suggesting. The big movers this morning include names like Hindalco, Adani Enterprises, Bajaj Finance, Divi's Labs, Coal India, IndusInd Bank are a couple of other names that are in the green right now. In fact, there's hardly any stock in the red except Apollo Hospitals. That one is marginally in the red, but otherwise it's a very good-looking screen that we have on our hands. A lot of result reactions as well. SBI is up almost about 0.5%. Zomato, Interglobe Aviation, all in the green at the moment. In fact, I think Zomato is up about 4.5% now. It came out with its numbers on Friday, but then there were, of course, brokerage reports that have, upgraded their target prices, earnings estimates on the stock, so looking pretty good there. And Interglobe Aviation is the other one in the broader markets that's looking very good. The mid-cap index, in fact, the advanced decline ratio is well in the green right now, so over 2,200 stocks on the advancing side. And plenty of names. So it's really, we've gotten off to a very good start, almost a century now on the Nifty.
Absolutely. And mid-caps are keeping pace. The mid-cap index is up 200 points. That's a 0.5% rally on the mid-cap index. Small-cap index will also come up for you on your screen, open with significant strength. Some of the notable gainers, Ikeo Lighting is up 8%, reacting to strong numbers, top-line growth of 48%. There is gross margin expansion, and the stock has surged. Aarti Industries, where Sonal was telling us that on a quarter-on-quarter basis, we are seeing an improvement. So revenues went up 3%, the EBITDA went up 16%. So the street is latching on to the sequential improvement seen in Aarti Industries. Data patterns too, strong numbers, stock gains 4%. JK Lakshmi Cement, where the numbers look good, has opened higher. JSW Infra, where the management just told us that H2 is going to be stronger than H1, and they've got a couple of acquisitions in their bag, is higher in trade. And Aeroflex Industries, small company, 2,000 crore of market capitalization, but the company is gunning for a 30 to 40% top-line growth. Other notable gainers include in Godrej Agrovet, Thermax. These are stocks with gains of 2 to 3%. Thermax is a steady set of numbers. And PB Fintech. PB Fintech this time has reported a loss of 21 crores, but the stock is open higher in trade. On the losing side, it's Bank of Baroda. 4% gone on Bank of Baroda in opening trade. And you've got red on the screen for earnings, reaction stocks like SCI, Poly Medicure, Gati. These are stocks which have opened with cuts after reporting their Q2 numbers.
All right. Well, let's just, so it's a solid start, right? 100 points, 19,325 is where we are at. And it's looking very, very good. 0.5% higher. I just want to take a quick look at some other sort of movers. Actually, why don't we look at the indices, right? The Nifty Bank will come up on your screen, which is about 0.4% higher. So, yeah, in line with what the Nifty is doing. Let's look at the strongest of the lot, which is the small cap space. I think, and just an alert for the ticker team, I think the small cap index is back at a new high. Maybe we can quickly check that and put it out. The small cap index, I think, is come back above the high. The previous high was 13,148. Okay, maybe not yet. The high this morning is 13,113. So we are, I think, just there, almost there, 0.5% less than that from its previous all-time high, the Nifty Small Cap Index. The mid-cap index has got some more, distance to cover. And that will come up as well on your screens. 0.5% higher of the small cap index. It's a little weaker as compared to what the Nifty is doing. Just a few other names. So Zomato, of course, is the biggest volume-led gainer right now. It's about 4% higher, 121. We highlighted that. Bank of Baroda, is down 3%. It's got volumes behind it as well. So BOB is down at about 197. JP Power is coming up. I mean, we don't usually mention it. 12 rupee stock, but 10% and huge volumes in this one. I think it was up 10% on Friday as well. HBL Power reported numbers, that is HBL, 11% higher, and it's got humongous volumes as well. So 319 on HBL Power Systems. Look at that, 1 million plus shares on that one straight off the bat. There is Hoodco, which is up about 3.5%. Indigo, we've been, of course, highlighting how the numbers are strong. Indigo starts about 2% higher. It's got decent volumes. By the way, out of the gates, you got very strong volumes across the board. This is, of course, a cursory look at what the market is doing, but that volumes are strong. JK Cement will come up, 4.5% gains. I'm only highlighting things with large volumes, and JK is one of them, 4% on the back of volumes. Bajaj Hindustan, was strong on Friday. It's strong this morning as well, with I think about a 5% pop. And JSW Infra, we heard from the management just 5 minutes back. JSW Infra is starting 6% higher as we start this particular session. So it's 4:1 in favor of advances in terms of what we have on our hands. Gujarat Fluorochem is down 5% at about 26.30 or so. And that is looking very, very weak. So, a lot of movers and shakers, but mostly stuff on the upside as the market breadth, volumes, etc. indicate for now. We're at about 19,330 with a 100-point gain to start the week and start the day as well. Dheeraj Agarwal is with us, Managing Director of Ambit Investment Managers. Dheeraj, good to have you with us here. Great, as always, to speak with you. What's your sense? I mean, just do a quick check on earnings for us and what you're hearing from the research team at Ambit. How are they looking at it?
So earnings, you can divide that into two parts. At the EPS or the earnings growth level, it's looking quite strong, right? Almost 32% kind of earnings growth, similar to what we did in first quarter as well. But the top line growth is actually very, very pedestrian at about 7 or 8%. It's not disappointed this quarter as compared to last quarter. Last quarter, it was actually below expectations. So negative surprises on top line in this quarter is lesser as compared to last quarter. But at the volume and revenue level, that's a bit of a worry. And margin impact, which is flowing through the bottom line, which will actually start to fade away from next quarter onwards. So all hope at this point of time rests on the proverbial festive season demand and the second half demand recovery. We have been every single year we wait for that. So let's see how that pans out. But that I would say is a little bit of a red flag on the earnings side.
Okay, a red flag on the earnings side. By the way, it's looking very good. Look at Zomato, 100% higher now for the year. It's a fresh 52-week high on Zomato, 119 rupees. Yeah, that's a classic case of consumption coming back in a big way, right? I mean, Blinkit. I use these apps on a daily basis, whether it's Zepto, Blinkit, I've become so used to all of this, right?
That's right.
It just goes to show how the consumption piece is picking up in a big way. So as you were talking about the festive season, wanted your understanding on how these platform companies are expected to do from your end. And despite the rally that we've seen in names like Zomato, does it still make sense to buy?
So the platform companies, the trend is unstoppable. As you rightly said, everybody is using it. Everybody is using it on a daily basis. So at some point of time, the call will be on what kind of valuation do we ascribe to what kind of growth which is there. So that's one part of it. So without going specifically into stock-specific recommendations, that's a trend which is here to stay. But when we're talking about the market as a whole, we have to see whether X is growing or Y is growing, it doesn't matter. But how is the entire aggregate market demand scenarios looking at this point of time? And that there are some signs of weakness. So Zomato, of course, is taking market share away from other traditional channels. The ease of convenience, and once you get used to it, you just keep on using it irrespective of a little bit of service fee or convenience fee which they now charge. So that's a positive trend, that despite some service fee and convenience fee coming in, the demand is not really dropping. Unlike, let's say, in the past where Indians supposedly very, very value conscious and the slight amount of price increase, demand just drops off. That hasn't happened. But yeah. So
would you buy now or would you not?
Zomato, I would not comment on the specific stock price at this point of time, yeah.
Dheeraj, when you speak to foreign investors, right, long term they're very bullish on India, but they haven't put money in the Indian markets, at least in the last 3 or 4 months. Do you think now that the trend of rising US yields has reversed, the cost of capital will come down. Do you think the FIs will start investing back into the Indian markets over the next, say, 1 or 2 months? And therefore, would the typical FI favorites come back into flavor?
I'm not sure about that. And if you actually zoom out, forget about the last 3 months, last 6 or 7 years, if you see FI holding in Indian markets has been pretty static in the 19 to 20% range. So this is a very, very strange case. Whenever you meet any global investor or asset allocator, they all love the country, they all love the growth which the country is promising or showing at this point of time. But when you come down to actually stock picking, they find the markets a bit expensive. And which is what I think continuously holds the incremental flow back. That's one part of the story. If we actually zoom out a little bit at the large cap level at least, adjusted for US dollar or INR depreciation versus the US dollar, we haven't actually done significantly better than the S&P 500. So which is another disappointment from a FPI large cap allocation point of view. But two interesting things are happening. 5 or 6 months ago, or maybe 8 months ago, if we see FI ownership in the mid caps, that has suddenly shown a sharp inflection upwards. Now, whether this is a short-term inflection which will fizzle out or whether it can continue. In fact, if you actually draw the FI holding to mid-cap chart, the inflection looks very similar to what we saw in 2016, at the beginning of 2016. And that lasted for about 1.5 years or 2 years. So that could be a possibility, which is why, I mean, again, small and mid-caps have lesser absorption capacity, so we might not see too much of large swing on the headline FI inflow number. But we have to actually dissect and see where they are selling and where the money could possibly be going.
Just a few more names I'd like to sort of highlight before, and we'll continue the conversation with Dheeraj. Look at Aarti Industries. It's up a full 7%. Huge gains, by the way. But it's such a bombed out name, right? And we were talking about chemicals earlier. Prakash was highlighting specifically Aarti. And of course, Sonal was talking about Aarti as well. So 7%, 492. It's coming off very, very beaten down levels, but it's coming up. JP Associates is up 4%. Huge volumes here again. I mean, now these are the smaller turnaround to be turned around or whatever you want to call it. But 5% on Suzlon as well. Suzlon is now past the 35 rupee level. So these two have done well. Idea, for example, had a great week, the last one. So in the same kind of line, the same kind of stocks there. Which have been running up. Shakti Pumps is up about 5% or so, coming up with a volume. So there is enough and more happening in the broader screen, and it continues to show up in a significant way. Dheeraj, we also get into the election season, right? Yeah. Chhattisgarh polls tomorrow, then they've got MP, Rajasthan on the 25th. There is, of course, Telangana, Mizoram as well. But these are the big three Hindi-heartened states which markets are going to be watching out for very carefully. How important are these for markets, you think?
At least in the last few years, we have seen that the state election results haven't really mattered much as an impact on the markets. It will probably cause a few days of volatility into the result season for the state elections. I mean, last time around also when there was a bunching, I think 2019, right? When there was bunching of 3 or 4 states and a couple of them were upsets, barring a one-day fall, the markets didn't really do much. So the general belief at this point of time is that the nation is voting for states in center in a different way. And hence the earlier extrapolation of the state election results onto what might happen at the central elections is no longer that valid. So I think it's just a sideshow.
Okay, by the way, some stocks, right? Data Patterns reported a good set of numbers, strong set of numbers. That stock is up almost about 5% right now and has had a rollicking ride this year, up about 85% this year. PB Fintech is also up 4% post its numbers, so that one's looking pretty good. Metropolis Health had a strong showing a couple of days ago, so that one is up. And Nykaa, ahead of its numbers, today, Nykaa is up almost about 3% So all the platform companies getting a fresh set of wings after Zomato's good performance. But Dheeraj, what are your thoughts on the traditional, old economy sector, so to speak? Infrastructure, for example, everyone's expecting, a strong showing from the capital goods space, especially as we run into election season. But stocks like L&T have already given you great returns, 40% this year, very good numbers as well. Do you think this is a sort of a structural up move, and is there more to go on the upside, both in terms of valuation and growth?
I would be slightly cautious, and the reason for that is bulk of the story this year is played out. So this year's large amount of capex boost has come from government spending. Government capex is expected or budgeted to be up 25% this year. YTD, we're already running at 45-46% growth. So which means unless the government can spend more than what they have budgeted this year, which is unlikely, I would expect some amount of slowdown going into the fourth quarter. So bulk of that money is already spent. Second, if you actually look at our fiscal deficit targets given by the government, which I think the government will stand by for FY25 and FY26, there is no way the same pace of government capital expenditure growth can be maintained. So look for some bit of softness in the government capex next year. Private is picking up, but not strong enough to take the full slack.
All right, Dheeraj, we'll leave it there for today. Thank you very much for joining us. By the way, you may want to listen to the next one. JSPL, I remember Ambit last week put out a call on JSPL, and you guys were negative comparing it to an earlier high debt cycle. And that's exactly what my colleague Sudarshan wants to address. So this is clarification sort of coming in through from JSPL with regards to the capex details which were announced along with the second quarter, which the market did not like. Sudarshan, take it away.
Yes, JSPL will be in focus today. Company with its Q2 earnings had announced an increase in capex to rupees 31,000 crore from 24,000 crore. And on the back of that, there were concerns related to costs increase. Company has now disclosed to exchanges saying it has rectified the information with respect to capex details announced with Q2 earnings. It says some erroneous information was given due to lack of understanding on the part of the team involved in preparation of the investors' presentation and conducting earnings call. Company now says there is no escalation in project cost or timelines. Capital expansion program is on track and there is no cost escalation in projects originally announced. Also, new projects have been added to expansion program and state-of-the-art hot strip mill is installed and production will start in Q3 as per schedule.
Okay, all right. Thanks a lot, Sudarshan, for that important update coming in there on JSPL. But let's move on. Star Health is on our radar now. It was a weak performance from the company in Q2. Their claims ratio was weak. The combined ratio is higher on the back of higher claims, but the company will not be able to meet the combined ratio guidance of 93 to 95% for FY24. Nilesh Kamli, the Chief Financial Officer at Star Health and Allied Insurance Company, is joining us now to talk more about that. Nilesh, thanks a lot for joining in. I just want to start by asking you about the second half of the year. What is your expectation? It was a pretty weak first half that you saw. The combined ratio is, has seen a bit of a weakness. The Q2 growth has slowed down as well. The claims ratio has also weakened quite a bit. So just tell us, for the second half of the year, what is the expectation?
Thank you for having me on the show. So for the first half, we grew by 18%. We continue to maintain our market share at 33% and grow in line with the industry growth rate. Our combined ratio was slightly weaker because of the expense ratio. Our loss ratio, in fact, was better than last year for H1 this year. Expense ratio, again, we have done some investments in tech and digital capabilities, and the operating leverage benefit will come in the second half of the year. The loss ratio was slightly lower, but Q2 was slightly higher compared to last year Q2. See, one has to understand that Q2 is a higher loss ratio quarter for a health insurance company because of the fever and infectious diseases that take place in this quarter. We have seen some impact in October as well, and hence we have said that our guidance might be pushed on the higher side for the full year.
You said that you won't be able to meet that combined ratio guidance of 93 to 95% for FY24. Where do you think you'll end the year at? And also for FY25, what is the kind of combined ratio guidance that you're putting out?
See, what we have said is the guidance might be pushed beyond the levels that we have given. We don't want to comment on the number. For FY24, again, we are taking certain steps. The price increase for our flagship product has taken place. We'll be taking price increase in other products as well. And this year, the epidemic was quite severe. The dengue strain was quite severe, which led to higher length of stay as well as higher claim size. We believe this was exceptional this year, and we should be on a profitable growth path as earlier period. We have taken some underwriting decisions also to bring in quality businesses in terms of giving.
Mr. Kamli, good morning. Sorry to interrupt. Good morning, Prashant here. So de facto, you're withdrawing the earlier guidance, right? To be clear.
No. See, we are not withdrawing the guidance based on the claim experience in the last, 45, 60 days. We have just given a cautious approach that we might exceed our guidance.
So we should not rely on the earlier guidance of 93 to 95%, right?
See, we are taking steps to ensure that, how we can bring in cost savings. The price increase is taking place.
Got it. So what would be the new number, Mr. Kambli? If you can give, that'll help. If you can broadly indicate.
See, we cannot comment on the number. We are in the middle of the epidemic. It has slightly continued in October as well. So we are doing our best to ensure that, we do our best in terms of combined ratio.
Sorry, what epidemic, sir? What is this? What?
Basically, the post-monsoon, the dengue, malaria, this fever and infectious diseases, those epidemics.
Okay.
So you have a target to grow at 20%. In the first half of the year, your growth has been about 18%, lower than that of the industry. And this is despite price hikes that you've taken in your flagship product. Can you talk about, growth for you in the second half of the year and even, this 20% growth target that you have?
Yeah. See, what we have taken is we have taken some underwriting calls, which has led to some lower growth. But our digital and banker businesses are growing fantastically at more than 50%. In Bankcard business, we have 44 plus partnerships today. The AU Finance Bank, Bank of Maharashtra, Standard Chartered Bank business will commence in this quarter. Digital business also is growing at 40% plus when it comes to new business growth. We want to expand in group health segment as well. We have identified SME and MSME segment as the growth driver. So all these initiatives in the agency business also, we have planned to open 1,000 plus offices. We have already opened 750 offices in the first half of the year. So all the infrastructure is in place. We want to do a sustainable growth in the future, and we are poised to grow at 20% plus in the second half of the year.
So 20% plus growth in the second half of the year. And for the full year, 20%?
Yeah, we should achieve our target of close to.
Okay. So you said you've taken some underwriting calls which impacted growth in the first half of the year. I believe that was letting go of high loss businesses in certain geographies. Is that correct?
Yes.
Has that been completed? And what was the impact of that in the first half of the year?
See, the impact is at least 2 to 3% when it comes to letting go of growth in the high loss ratio locations.
So that is the difference in a way between, because the industry growth is 25% in the first half at least. Your growth has been about 18%. You're saying for the full year growth will be about 20%, right?
See, the 24% growth for the industry is mainly because of the group health segment as well as the government businesses. We are talking about retail health businesses where we have 92% of our overall business, and that has grown by 18%. Retail health industry.
So just this letting go of high loss business, does it have to do with what's happened? I remember speaking about the issue and the dispute with hospitals in Gujarat, Ahmedabad, etc. Is it that?
No, absolutely not. No, Ahmedabad issue is related to claims settlements, which we have resolved. That has nothing to do with the high loss ratio segments. See, one more thing is the loss ratio, what we have seen, we can see it for other players who have published the results also. So it's more an industry phenomenon. The medical claims have increased.
Okay. I just had a couple of questions on the retail health segment that you were talking about. Your underwriting loss in that segment has increased 5 times on a year-on-year basis. And that has hurt the portfolio. Is that something that will continue in the second half of the year as well in the retail segment?
See, I would like to explain one thing. So combined ratio is a function of the operating result. When you talk about underwriting result, there are many factors. And we have been explaining this, that with growth in business, there is an upfront cost which comes. One more important point I would like to note is long-term business, which is 2-year and 3-year policies, today is 6% of our portfolio. So it's grown by 50%. While the earnings will come over 2-year, 3-year period, the cost of that business is upfront. That itself is a 50 crore strain on our business, which is the new business strain that we call it, life insurance business. So,
so that was my question. In the second half of the year, do you expect more of this new business loss? And if yes, what can you quantify it for us?
See, there are two things. One is for long-term businesses, we'll have to look at IFRS-based accounting. Even the industry has formed a committee to see how the accounting can be changed to bring in deferred acquisition cost, which the cost will also be deferred over the earnings period. But we are looking at various options to how to mitigate this.
So
We
on
have some
retail,
plans.
your share currently is 33%, right? The market share?
Market share is 33%.
Okay, and how much do you plan to grow it to over, say, the next 1 year?
See, I mean, we plan to operate or grow higher than the industry growth rate and gradually increase our market share over years to come.
Mr. Kamble, we'll leave the discussion here for now. Thank you very much for joining in. That's Star Health. Withdrawing the guidance on the combined ratio, but confident that they will be able to achieve a 20% growth for FY24. Let's turn our attention now to Titan. Reported numbers last week, a very good performance in Q2, a beat in the EBITDA and profitability. The revenue jump of 32% is optically higher. That's due to the sale of gold ingots. The watches business crossed the 1,000 crore mark for the first time ever. Ashok Sonthalia, CFO of Titan, is now with us on the show now. Thank you very much for joining in. Sir, can we begin by talking about how demand has been in the month of October? What can we expect in Q3 given the festive season and the wedding season?
We have this time, you know, that the Shraddh period, which was last year in Q2, has shifted to Q3. So first 15 days of October had some of that impact. And that is where it is very difficult to judge the whole quarter from the October performance. But second half of October has started pretty well for us, our jewelry business and some of the other businesses. So we are pretty hopeful that we will have a good Q3. Even on the solid base of last year, Q3, we should be able to deliver some healthy growth numbers.
Okay, so for the second half of the year, what kind of guidance can you provide in terms of, say, the jewelry business revenue? What are we looking at?
So second half is easier than Q3 for us to tell. And I definitely believe that we can do mid-teen to high-teen growth on the second half of this year.
Mid-teen to high-teen. What would margins look like, sir, in H2?
The diamond prices have come off on the large size stones, which are typically 1 carat and above. And if you look at Tanishq and carat lane diamond business, and for that matter, Mia also, bulk of the business is on the smaller diamond. We do have some large diamond business in Tanishq, in where the corrections have happened, and we would also do a little bit correction on our prices. But that is not material enough to kind of call that out, that what could be of impact it can happen, and still it is unfolding. And like earlier, quarters, we have stated that annually 12 to 13% EBIT margin for jewelry business on a standalone Tanishq business, and we are still very confident that we will deliver within that for the full year.
So what's the outlook on margins? Is there a possibility that margin upside can be capped given the strong competitive intensity in the industry?
Yes, you are right that margin expansion in jewelry business is not going to be easy. Competitive intensity is high and everybody is expanding, national players, regional players, local players. And our focus always has been to kind of growth, number one, and at a sustainable margin basis, sustainable and consistent margin basis. And that is where that 12 to 13%. We are more interested in gaining market share, gaining more customers, and which we are very successful. If you track in last 3-4 quarters, we have been talking about our new customer, repeat customer ratio is around 48 to 52, 47 to 53 sometime. And this quarter, the Q2, which we just concluded, the growth has come equally from the ticket size as well as the buyer growth. So we are able to gain market share consistently. So that's the strategy, keep gaining market share and deliver a consistent margin.
So, there is a big change happening in the diamond market now, right? I mean, suddenly lab-grown diamonds are all over the place. And do you think that could impact the overall demand for diamond jewelry? And how are you preparing for that?
In India right now, lab-grown diamonds are not at all impacting demand. Consumers are still not asking for that. But if you look at the US market, which is always, in a way, a few years ahead as far as diamond jewelry is concerned, They are the bridal segment, which is 40% of diamond jewelry market in US. Out of 40%, yes, we are also hearing and getting the signal. 40 to 50% of the center stones are getting replaced by lab-grown diamond because people are able to afford higher size of lab-grown diamond in lesser price than, you know, on a smaller stone, 1 carat, 2 carat of natural diamond. So that shift is happening. We are keeping an eye on all these developments. We have a minority stake in a lab-grown diamond jewelry company in US, and purpose of that stake, which we did 2 years back, 2.5 years back, 2 years back, I think, was this only, that we can keep a close eye on the lab-grown diamond market development.
So what is the guidance on other verticals, watches, wearables, ethnic wear?
So watches business, of course, is doing extremely well. And within that, wearable is really exploding. India has become the largest global market for wearables in terms of number of units, even ahead of China and US. And we are playing our game nicely in that, and we will try to keep maintaining our differentiation in the segments where we are playing. Even on the analog side, on the premium side, we are seeing very, very healthy growth, which is the Helios, our international brand, Channel and Titan brand. They are doing extremely well. And we are also taking some concrete step on further premiumization or further premium offering coming from House of Titan. So we are very, very positive about the overall watches and wearable segment. The other smaller businesses currently, they have only growth targets and growth support, coming in from our side. They are just focusing on their growth. Taneira is shaping up very well, very, very a brand which is being kind of loved by early consumers who have so far come and experienced that brand. We are trying to create a unique proposition again, the way we did in jewelry, where the weaver salas for the bunkers and pure natural fiber, handcrafted. That's the offering under Taneira, and it's taking good shape. Of course, eye care is profitable, doing well. We would like it to grow much faster. Last quarter, it was 12%, and some of those things are being thought about by the business teams, that how can they accelerate their growth trajectory.
So what's the long-term outlook or the strategy for the eyewear business? And are you facing the heat or increased competition from larger players like Lenskart?
So in eye care, while opportunity is large, but yes, you are right. In a way, there are two national players, and the other player is, of course, growing faster than us. Their appeal to the youth and fashion seems to be higher than us, and we need to think about that. More serious specs buyer, I think, prefer us because of the quality of lenses and the craftsmanship of the what we do, our optometry. We are very serious about that because we believe this is an eye care business. Fashion is given. So we are working on some of those stuff. We launched that fast track channel, which was more targeted towards youth. Early days, only 5 stores are piloting, and we are kind of looking at that, what we can do. So you will find some of the new offerings also coming from Titan Eye Care stable to kind of not only improve our competitive position, but grow faster.
And what is the expected growth that we're looking at for CaratLane this year? What is the profitability like, and what does the balance sheet look like post the debt raising?
CaratLane have so far in the year grown 45-46%. I believe definitely for the full year that number is possible, and even they can inch up slightly going towards the remaining H2 closer to 48, 49 or towards 50%, but it's very difficult. But 45-46% is the run rate currently. In the first half of the year, their EBIT operating profit margin was single digit on the lower side, 4-5%, which they have, I think, opportunity to further expand. It will take 2-3 quarters. In any growth company which is more digital oriented, and performance marketing, digital marketing are slightly expensive because of various features. So they are kind of readjusting some of these levers, and even the diamond sourcing, some of the help coming from Titan on that, etc., will help them improve their EBIT margin. And it's a long-term margin expansion and growth story. You know, it is just not next quarter or 2-3 quarters. We believe this opportunity exists for 5, 7, 10 years for them to kind of keep improving some of these parameters. As far as borrowings are concerned, we very, very successfully completed a non-convertible debenture of 2,500 crore at 7.74% interest. And you know, while on 30th September you find working capital borrowing was 4,000 crore, but that will gradually come down. Festive season, a lot of good cash collection happens. I would imagine that December end, we should be, including NCD, we should be 3,000, 3,500 crore. And that's the level until unless we do something else, I expect to remain for some time.
Okay, thanks a lot for that and all the best for the quarters to come. Let's slip into a quick break. On the other side, we'll be joined by Kaleeswara N. Arunachalam, who's the CFO of Crompton Greaves Consumer Electricals, to discuss their performance for the quarter gone by. Stay tuned.
Okay, the market's up 100 points, but it's not as if it's building on those gains in any significant way or anything. There's enough happening in the broader markets as well, which we'll keep coming back to, but 0.5% higher, not a bad start at all, and enough in the tank in that sense. Let's talk about the next company we have on our radar. Crompton is what we're talking about. It was a soft quarter for the company. Revenue growth has been muted. The lighting business has shown a weak performance, while their ECD and butterfly margins were under pressure. Mr. Kaleeswaran Arunachalam is the CFO of the company. He's joining us right now to take some questions. Mr. Arunachalam, great to have you with us here. Thank you very much for your time. I believe you've got a conference call with analysts lined up in about 30 minutes from now, actually in about an hour from now. So good that you're speaking with us before that. So I want to start, of course, with, I think, what is top of mind, what will be top of mind, which is, this entire thing with Butterfly, the cancellation of the amalgamation of Butterfly with Crompton. I mean, what happened? What do you think went wrong, and why did people vote against this? And what is going to be the impact, really, in your assessment?
Yeah. Good morning and thank you. To start with, on the Butterfly voting results, we do respect the final outcome that it turned out as it to be. It is important to note that we got the support from largely on the institutional investor side. It is the non-institutional investors where we couldn't garner the support that is required for the merger to go through. And as we stand, when we acquired Butterfly to now, we have been working on two tracks. One is how do we operationally integrate the company, and second is the legal merger of the company. While the legal merger is something that has fallen off at this point of time, the operational merger has been working out successfully for the last 18 months. The cost and revenue synergies that we were supposed to obtain via the Butterfly acquisition will continue to stay true. We don't see any significant challenges coming on that area due to the merger not going through. And as a way forward, at this point of time, we believe we would like to operate these as two separate listed entities, and we will have their way forward charted out accordingly. And we do think from this perspective, we would strive to get all the synergies coming through, and that would also be a great value creation opportunity for both the company shareholders in the future.
Yeah, Mr. Arunachalam, so this was supposed to drive focused kind of synergy benefits, especially in the kitchen appliances segment once the amalgamation, etc. went through. You're saying it will have no impact whatsoever? That is one. And second, will you bring this up again? And at some point in the future, does this, or you think it's off the table now?
I'll answer your second question first. It is off the table for now. We are not looking at reinitiating a merger in the near term at all. Considering the individual performances of both these companies in the last 6 to 12 months, and considering that we are able to get the synergy benefits, both on the revenue, which we have started the work almost 6 months back, when we wanted to work on the Crompton's distribution strength to make Butterfly a pan-India brand. We have made early progress in that. We have started with a few markets in North as a pilot. That is going on well and it is on track. In terms of the cost synergies that we have to obtain with Butterfly, the projects that we have to work through our campaign program of Unnati continues to now encompass Butterfly also. We are seeing synergies coming through on the cost reductions also. So I don't think so there is any challenge on the revenue or cost synergies that we have to obtain with or without the merger. Having said that, there will be very minimal costs that we need to incur for operating Butterfly as a separate listed entity on the statutory side. I don't think so that will come in the way of getting our synergies through.
Okay, got it. So you're not looking to reinitiate the merger anytime soon, and you will continue to operate them as two separate listed entities. Got that. I want to talk a little bit about the other businesses, the lighting business particularly, which has been, on the weaker side. And you did mention in your presentation that you're seeing some demand challenges in the B2C segment. Tell us a little bit about that. When do you see a recovery come through, and what is the expectation for the lighting segment in the second half of the year?
Sure. Let me divide lighting into two parts first. One is on the B2B side and on the B2C side. From a B2B perspective, we are already seeing green shoots coming through. Our progress towards both the MTO business and the MTS business for B2B is on track. We have also obtained two prestigious orders recently for working on the Mumbai coastal line and the Noida International Airport. With that, we think lighting B2B business is going in the right trajectory. Second, on the B2C side, if you look at it, we were probably a market player who started with bulbs and battens as our core category. Now we are expanding into ceiling. Some of the interventions that we have made at this point of time towards lighting business is one, we have got this out from ECD and got a dedicated sales structure for lighting, considering the distribution challenges and opportunities of lighting is significantly different from that of ECD. We think this will bring in the required focus to the category, and it will also ensure that over a period when we start moving towards higher share of business in our categories like ceiling, we should be able to see our B2C business also picking up. Most importantly, I would like to reiterate here, B2C as a segment has been going through price erosions as an industry as a whole. And that is something which is not unique to Crompton. But amidst all these things, the unit economics and financial model of Crompton lighting business has solidified significantly. If you look at our lighting business for Q2, we could expand our EBIT margins by about 250 to 300 bips and also deliver almost a 20% absolute EBITDA growth over last year in spite of softer top line. So our actions, we think, is taking us to the right direction on lighting. Our unit economics are very strong and supporting us towards the initiatives that we need to take to be relevant in the market. And that as a combination of B2B and B2C with the new structure that we have put in place for lighting should help us grow in the coming quarters.
Got that. We'll leave the discussion here for now. Thank you very much for joining in. That's Crompton for you. Moving on to Escorts Kubota. The company reported a strong performance with the highest ever quarterly revenues. Margins improved by 480 basis points, though the tractor volumes were slightly lower. Bharat Madan, the whole-time director and the CFO of the company, is with us on the show now. Bharat, morning, and thank you very much for joining in. Can we talk about the tractor volumes down 7% on a year-on-year basis? What can you guide for tractor volumes in the second half of the year? And what can you end the year with? Bharat, can you hear us?
Hi, good morning. Can you hear me now?
Hi, we can hear you loud and clear. So just wanted to understand the outlook for the tractor volumes in the second half of the year.
Sure. So just responding to your question, I think the second quarter, as you know, last year the base was high and the festive season actually had started from September itself. That's why we see very good base was there in terms of the growth last year itself. So the season has shifted to October and November. So even though October has been soft because of this shifting of the season to 2 months now, but November looks like it will be better than I think the last year. So overall, we expect the tractor industry has already hit a new peak last year, and we expect the industry this year is likely to be more or less flat, or maybe plus minus 2%, depending on how the last quarter goes. In third quarter, we are looking at more marginal growth, maybe 2-3% again, and Q4 we probably again see similar growth number. The first 6 months have been lower, but I think it will get made up slightly in the balance of the second half this year.
Okay, so you're saying the tractor industry will be flat or at best about plus minus 2% and a marginal growth in Q3. Is there scope to increase margins further? I mean, this one was a good quarter for you because raw material costs have come off quite a bit. But from this 12.2% level that you're sitting at, can you build on to it in the second half of the year?
Yeah, so normally if you look at the margin profile, the second half is better for Escorts historically. So we expect the margin actually will improve. Second quarter actually is the softest quarter with the sales volume are quite low. And the production numbers are good, so that's why you see slightly better margin. But if you compare to first quarter where you see an almost 13.5% plus margin, in tractor business. So I think overall full year basis, we expect the margin to be higher than Q2 definitely. I think it will be range of 13 to 14% sort of category in this business.
Okay, we'll come back to this business in a bit, but I just wanted some clarification from you on what's happening with the railway business. Our sources at CNBC-TV18 indicate that Nor Bremse, the group, is likely to buy out Escorts' railway business. Is there any truth to that? Any kind of timelines that you folks are looking at to sell the railway business?
Also, we had already, I think, clarified to stock exchanges. This is all market speculation, and as a policy, we don't comment on it. And we also confirm that there's no truth to that statement, I think what was mentioned. So, yes, I mean, the business is doing well right now. I think you've seen the kind of growth railway has performed, and we remain quite bullish on that business. So, I think both on the infrastructure side, railway and equipment are doing extremely well. And we continue to focus on those businesses right now.
So, you're saying there's no truth to the statement, but I just wanted to understand, are you in talks with the Nor Bremse group at all? I mean, have you had any conversations with them over the last 12 months?
Yeah, as a policy, company keeps evaluating various options. So it will be difficult to say whether we are discussing, but we discuss multiple scenarios when you're doing an ongoing business scenario. So nothing concrete. If something material happens, definitely we'll come back to the market and inform everyone. But as of now, there's nothing, no such development.
Okay, nothing concrete yet, but talks are always ongoing to evaluate the business opportunities for your various segments. The construction segment, highest ever quarterly revenues, volumes are strong, I think at close to about 1,580. What's the demand trend looking like for the construction segment? Any volume number you'd like to share?
So construction equipment is showing very good growth. Looking at the government spending on the infrastructure space this year, so the kind of capex government has earmarked is huge. So we're seeing almost 40-50% sort of growth coming in that business now. And second half normally is a good period actually for construction equipment. So first half typically because the monsoon is slightly lower, even though this time because of the delayed monsoon and patchy monsoon, and the second quarter saw very good demand. So we expect in H2 also demand will continue the way I think we've seen in the first half. So the same momentum will continue. And there's also the likelihood of some emission norm changes happening from 1st of April, in this segment. If that happens, there'll be some pre-buying also, which you can see happening in the last quarter of this year.
Okay, just coming back to the railway business, I understand that you said that all these talks of selling the railway business are speculative as of now, but you also mentioned that the railway business is doing very well, and this time there was the order book came in at almost 870 crores. What is the kind of order visibility that you have over the next 12 to 18 months, and how much of this current order book would you be executing by the end of FY24? If you can just share some numbers with us as to what the growth in the railway business could look like.
So look at the first 6 months, I think we've already done more than 500 crores of top line in this business, and we expect similar number will happen in the second half. The order book number may not show that sort of growth because the execution pace has now increased. So you see the higher number coming up every quarter. In the first 6 months, we've seen more than 40-45% growth happening in this business now. So definitely the pace of execution of orders has also increased. So the current order book will be able to execute over the next 6 to 8 months. And you can expect the similar growth momentum will continue going forward also in this segment.
Thank you, sir, for joining in. That's the work coming in on Escorts Kubota. Cello World will be listing today, and let's get the early rates up for you on that. Cello World, the price was 648. The company raised a total of 1,900 crore rupees. It was a pure offer for sale of 1,900 crore rupees, but 1,500 of that was done by the promoters. The subscription was pretty strong at close to about 38-39 times. So we'll await the listing on Cello World for now. Here's what we'll do on that note. On the other side, we'll slip into a very short break. We'll come back. We'll talk commodities. Manisha Gupta joins in on the other side.
Welcome back. We have Manisha Gupta joining in now to give us a sense of which way commodities are headed. Manisha, good morning.
Morning, and I'm looking at metals as a sector because we've seen positive cues continue for this one. Remember, for the last couple of weeks now, we've seen gold prices hold around that $2,000 per barrel per ounce mark, and we have seen most of the other metals also post week-on-week positive rates, and that is after the Fed has eased the rate cycle. The last two meetings have not seen any rate changes, and then we've seen stimulus come in from China as well to support the economy. The dollar index and the treasuries also have come off their highs that we saw recently. That in turn also has been supportive for the dollar-denominated commodities here. Markets also are looking at the US data non-farm payroll that came in on Friday, where we saw 150,000 jobs added versus the estimate of 180,000. And that leads to belief, and that also shows up in the CME Fed Watch, which says that there is a 95% chance that the December meeting will also go uneventful, as in there wouldn't be another rate hike. And that is what the markets really seem to be feeling in right now. If you look at the last 1 week, then we have seen almost all metal prices trade in the positive, anywhere between 1.5% to 3.5% on the higher side. The best of the gains clearly coming in for steel prices, but zinc, aluminum also gaining 2% in the previous 1 week there. This is even as we have seen on ground Shanghai inventories actually gain in the last 1 week. So we are looking at 5 to 12% of a rise in inventories on a week-on-week basis. So actual on-ground demand is yet to come in, but the market's clearly playing it onto sentiment right now. Having said that, there's a lot of data coming in on this week as well. And the most important out of that is the Chinese numbers, where we have seen China trade data coming in and China inflation data that comes in on Thursday as well. Those are the gold prices, which have gained 7% in the month of October. There's a lot of safe haven buying that we saw into that month. But I also want to take you to the CFTC data, and that will show you the picture on how strong the demand clearly has been. So when you look at the longs, those gained up by 15,000. So we are standing at a net long position of nearly 1 lakh contracts when it comes to gold. These are all the longs there. When you come to shorts then, and we have seen a decline come in for this one. So there's a lot of short covering happening in gold as well. And we have seen those contracts decline by 3,500. So total shorts as of now stand at 14,000 versus longs of 1 lakh contracts. Clear cut support continuing in case of gold prices there.
Okay, thanks a lot for that. Let's slip into a quick break. On the other side of the break, Lata Venkatesh will catch up with Suresh Ganpati, the banking analyst of Macquarie Capital Securities, to discuss the Q2 performance of the banking and financial sector. Stay tuned.